Hey champs! Welcome back to MoneyMind Quest, your pilot for financial education and smart investing. Today, we're diving into the exciting world of cryptocurrency. If you've been curious about what cryptocurrency is, how it differs from traditional money, and whether it's the cash of the future, you're in the right place. We'll also discuss diversification, the risks involved, and how to start investing safely. Before we proceed, be sure to join the MoneyMind Quest champs, smash the subscribe button, and let's get started. First things first. What exactly is cryptocurrency? In simple terms, cryptocurrency is a digital or virtual form of money. Unlike traditional currency, which is issued by governments and banks, cryptocurrencies operate on decentralized networks using blockchain technology. Blockchain is essentially a public ledger that records all transactions securely and transparently. Now, you might be wondering, how is this different from the money we use every day? Traditional currencies, like the US dollar or the euro, are controlled by central banks and government. They regulate the supply and oversee the financial system. Cryptocurrencies, on the other hand, are not controlled by any single entity. This decentralization means that transactions can be made directly between users without the need for intermediaries like banks. There are thousands of cryptocurrencies available today, but let's talk about some of the most popular ones. The first and most well-known is Bitcoin. Created in 2009 by an unknown person or group using the pseudonym Satoshi Nakamoto, Bitcoin was the first cryptocurrency and remains the largest by market capitalization. It's often referred to as digital gold due to its limited supply and store of value properties. Another major player is Ethereum. Unlike Bitcoin, which is primarily a currency, Ethereum is a platform that allows developers to build decentralized applications using smart contracts. Then we have Litecoin, Ripple, and many others, each with unique features and uses. So, is cryptocurrency the cash of the future? It's a complex question. Cryptocurrencies offer numerous advantages, such as lower transaction fees, faster transfer times, and increased privacy. They're also accessible to anyone with an internet connection, which is particularly beneficial in regions with limited banking infrastructure. However, the future of cryptocurrency as a replacement for traditional money depends on many factors, including regulatory acceptance, technological advancements, and mainstream adoption depending on laws and regulation. For now, cryptocurrencies are more commonly viewed as investment assets rather than everyday money. Speaking of investments, can you diversify with cryptocurrency? Absolutely. Diversification is a key principle in investing to reduce risk. Just like with stocks, bonds, or real estate, you can diversify your crypto portfolio by investing in different types of cryptocurrencies. This way, you're not putting all your eggs in one basket. However, it's crucial to be aware of the risks involved. Cryptocurrencies are highly volatile. Prices can swing dramatically in short periods, which can be nerve-wracking for investors. Also, the market is relatively young and can be susceptible to regulatory changes, technological failures, and market manipulation. Let's talk about how to avoid the dangers of investing in cryptocurrency. First, educate yourself. Understanding the market, the technology behind cryptocurrencies, and the specific assets you're investing in is vital. Avoid falling for get-rich-quick schemes or following the hype without doing your research. Next, use reputable exchanges and wallets. Make sure the platforms you choose have strong security measures and a good track record. Diversifying your investments and not investing more than you can afford to lose are also crucial strategies. And remember, at MoneyMind Quest, we always emphasize the importance of proper financial literacy. Check out our other videos on financial education to build a strong foundation before diving into any investment. So, how do you start investing in cryptocurrency? Here's a simple step-by-step guide. Educate yourself. Research. Begin by learning the basics of cryptocurrency, blockchain technology, and how these digital assets work. There are numerous online resources, including articles, videos, and courses, that can help you understand the fundamentals. Terminology. Familiarize yourself with common terms such as blockchain, wallet, exchange, private key, public key, and altcoin. This will make it easier to navigate the crypto world. Choose a reputable exchange. Popular exchanges. Some of the most well-known and trusted cryptocurrency exchanges include Coinbase, Binance, Kraken, and Gemini. These platforms offer user-friendly interfaces and robust security measures. Verification. Sign up for an account on the exchange of your choice. Most exchanges require you to verify your identity by submitting documents such as a driver's license or passport. Security measures. Enable two-factor authentication, 2FA, to add an extra layer of security to your account. Set up a wallet. Types of wallets. There are different types of wallets, including hot wallets, online, and cold wallets. Offline hot wallets are convenient for frequent transactions, while cold wallets, like hardware wallets, Ledger, Trezor, offer higher security for long-term storage. Wallet setup. Follow the instructions to set up your wallet and securely store your private keys. Never share your private keys with anyone. Fund your account. Depositing funds. Link your bank account or credit card to your exchange account and deposit funds. Some exchanges also accept PayPal or other payment methods. Budget. Start with a small amount of money that you can afford to lose. Cryptocurrency investments are highly volatile, and it's important not to risk more than you're comfortable with. Buy your first cryptocurrency. Placing an order. Choose the cryptocurrency you want to buy, such as Bitcoin or Ethereum, and place a buy order. Most exchanges offer different order types, including market orders, buy at the current price, and limit orders, buy at a specific price. Transaction fees. Be aware of transaction fees, which can vary between exchanges and cryptocurrencies. Store your cryptocurrency securely. Transfer to wallet. After purchasing, transfer your cryptocurrency from the exchange to your personal wallet for better security. Leaving your assets on the exchange exposes them to potential hacks. Backup. Make sure to back up your wallet's seed phrase and store it in a secure location. Once you get proficient with it, you can comfortably navigate to the next stage. Diversify your portfolio. Explore altcoins. Once you're comfortable with your initial investment, consider diversifying by investing in other cryptocurrencies beyond Bitcoin and Ethereum. Research and choose projects with solid fundamentals and strong communities. Risk management. Spread your investments across multiple assets to reduce risk. Don't put all your money into a single cryptocurrency. Stay informed. Market news. Follow cryptocurrency news to stay updated on market trends, regulatory changes, and technological advancement. Websites like CoinDesk, Cointelegraph, and CryptoSlate are great sources of information. Technical analysis. Learn the basics of technical analysis to understand market patterns and make more informed trading decisions. Join crypto communities, online forums. Participate in online communities such as Reddit, Bitcoin Talk, and Telegram group. Engaging with these communities can provide valuable insights and updates. Social media. Follow influential figures in the crypto space on Twitter and LinkedIn. These platforms can offer real-time information and expert opinion. Consider staking and yield farming. Staking. Some cryptocurrencies allow you to stake your coins to earn rewards. Staking involves holding a certain amount of coins in a wallet to support the network's operations, such as validating transactions. Yield farming. In decentralized finance, yield farming allows you to earn interest by lending or staking your cryptocurrencies in liquidity pools. Be cautious, as DeFi platforms can be risky. Use advanced trading tools. Trading platforms. Explore advanced trading platforms like Binance Futures or BitMEX if you're interested in leverage trading. These platforms offer tools for more sophisticated trading strategies, but come with higher risk. Bots and automation. Consider using trading bots or automated strategies to optimize your trading efforts. Tools like 3 Commas or CryptoHopper can help automate trades based on preset conditions. Understand tax implications. Record keeping. Keep detailed records of all your transactions, including buys, sells, transfers, and the value at the time of each transaction. This information is essential for tax reporting. Tax laws. Familiarize yourself with the tax laws regarding cryptocurrency in your country. Some countries treat crypto as property, while others may have different regulations. Evaluate long-term potential. Research projects. Investigate the long-term potential of different crypto projects. Consider factors like the team behind the project, use case, community support, and technological innovation. HODL strategy. Adopt a long-term investment strategy by holding on to your assets despite market volatility. This approach is commonly referred to as hodling in the crypto community. Cryptocurrency investing can be a rewarding venture, but it's crucial to approach it with caution and knowledge. Always do your research, stay informed, and never invest more than you can afford to lose. As with any investment, a strong foundation in financial literacy is essential, so continue to educate yourself and utilize resources from MoneyMind Quest for further guidance. Don't forget to like, subscribe to join the MoneyMind Quest champs, and check out our other videos for more tips on financial education and smart investing. See you next time. Happy investing!